So what does all the pragmatism and the complexity do? At a philosophical, sociological level, it separates fact from value. It separates cause from effect. It separates definitions from words and concepts. You may recall from the podcast last week that the Moneyball Method uses a tool called the fact and value matrix. We do that for a reason. Fact and value Well, hello, objective investors. Thank you for tuning in to the Moneyball Method. My name is Mark Shupe, the author of the Moneyball Method, a Middle-Class Manifesto for objective investing. The subject for today's conversation is pragmatism and complexity. I know that sounds esoteric, but I'm going to try to make it fun. And what I have in store for you today is some information from a professor of economics at the University of Pennsylvania Wharton School of Business, some comments from a private wealth director at a major regional bank in America, as well as some advertising copy from a major investment management firm. But before we get into that, I would like to define some terms. And the first one is pragmatism. And to me, the best source for a definition of pragmatism is philosopher Dr. Leonard Peikoff. And I'm going to give you a brief quote of his. Dr. Peikoff says, "For the moment, the strategy worked. If it didn't, switch your viewpoint. There are no absolutes. This policy, of course, is called pragmatism. If there are no absolutes, there are no principles. And anything goes, whatever works in the moment. That means short-term thinking for short-term results." Now, how does that apply to your personal finances and investment strategy decision? To help better understand short-term thinking, I'm going to quote this week's presentation from a wealth strategist at a major regional bank. She quotes, "The U.S. District Court declined to break up Google, preserving its core business. We saw shares surge. What we thought could have been a headwind for the tech sector turns out it could be quite a tailwind for the tech sector in general. Although it's in an over-concentrated area, we still feel it has very strong earnings growth. What we've seen thus far with the S&P 500 is that technology and communication services are the leader." Let's break that down. What did we learn from that? Not a thing. Yes, the court did preserve Google's core businesses. Stock price did go up as a result. Everyone saw that. And it turned out to be a tailwind for the tech sector, which of course caused the price surge. It's an over-concentrated area. What does that mean? Over-concentrated to who? Where? Well, certainly technology dominates the S&P 500. As we discussed last week, this Magnificent Seven have been leading both the growth and the market capitalization of the index. Everyone knows that. We still feel it has strong earnings growth. The tech sector has had the strongest earnings growth trajectory for the last 30 or 40 years. There's nothing new here. We didn't learn anything, but the title of the presentation was 3 Things We Learned This Week. What we've seen thus far is the S&P 500 and technology services are the leader. Yes, we know. Number 2, we received the jobs report this morning, and hiring stalled in August. What was expected to be 75,000 non-farm jobs added, we saw that number come in at 22,000. Further, we saw that June and July were revised downward. Unemployment rose to 4.3%. You may be wondering, might this have an impact on what the Federal Reserve decides to do with interest rates? I am not wondering about that, but most of Wall Street does like to chatter about what the Fed might do. And there's certainly nothing new about employment numbers being revised downward or upward for that matter. And a 4.3% unemployment rate isn't really a big deal. It's fairly healthy rate of employment. There's nothing to learn here. Number 3, Fed Chair Powell stated before that the Fed is concerned about weakness in the labor market. They always say that. Therefore, coupled with my comments earlier and the Fed funds futures market, which has a 97% chance of a rate cut on the September 17th meeting, leads us to conclude that it's very highly the Fed will cut rates in a few weeks. That's self-evident. We remain ever vigilant watching what the Fed is doing and how they will act on interest rates. Ever vigilant. So what? I mean, how does that help you? How does that help you with your personal financial decisions? How does that help you with your investment strategy? What can we learn from 3 things we learned today? Nothing. Yet they claim their vigilance will help you, and I quote, the economy and stock market so that we can guide you appropriately. That's pragmatism. That's short-term thinking. And what happens when we adopt that mindset? Without absolutes, without principles, we lose track of essentials, we lose track of cause and effect, and that can only add complexity to all of the noise and nonsense that you're hearing about financial market strategy. What one of my astute book reviewers said on Amazon, the magic market whisperers. So to give you an example of the complexity as it applies to individual investment strategy decisions, the traditional advice model is dominated by economic forecasts, market predictions. It's also dominated by a style box of beating the market, but at the same time, filling all of the diversification style boxes, just in case you're wrong. The complexity also includes tactical rebalancing, where when some sectors rise faster than others, we take a few profits from the ones that rose the most and reinvest in the ones that fell. Does this add value to your investment strategy, to your personal goals, to your success? Probably not. And then there's reversion to the mean. This is the use of technical charts and analysis to try to predict the future based on price dynamics that we cannot predict or control, but it's essentially used to say that when the market drops sharply, it will bounce back, stay the course. And then, of course, throw in Fed policy, regulatory environment, and other government intrusion. This is a lot of complexity. None of it can we control. None of it can we predict. So let's go into some of these subjects in a little more detail. Economic forecasts. In my book, I suggested that you pick up any economic forecast from the last 50 years, and you'll probably find many of the same messages, the same ideas, the same thoughts. Most likely you'll find comments about, we're cautiously optimistic, but there's near-term uncertainty. There will be continued volatility, of course, headwinds and tailwinds. But they will also claim that the long-term growth trend is intact, but there might be potential policy errors from the government. That is true in just about every economic forecast. And instead of cherry picking something from the past to make my point, I went to an online blog whose audience is registered financial advisors and trust officers, and pulled the first article I could find that was written by an economist. This particular economist is Professor Jeremy Siegel, Professor Emeritus from the University of Pennsylvania Wharton School of Business. And I'm not going to read the entire commentary, but I did highlight a few sentences. He said, the policy debate has shifted decisively toward labor market weakness rather than transient price noise. Technical jargon. What's he talking about? Potential policy errors from the government. The second sentence that I highlighted says, this is what a weakening growth impulse looks like. What are growth impulses? I don't know. term premiums stabilize, and duration rallies as investors price in easier policy ahead. What is he talking about? He's talking about the bond market. He's talking about treasury bonds. What are term premiums? Instead of getting into the technical definitions of that, it just basically says there's going to be a difference in the yield between high quality or AAA rated treasury bonds and lower quality corporate bonds. I'm sorry, term premium actually refers to the yield curve and maturities. If you hold on to longer term bonds, you're likely to get a higher yield. There's nothing new about that. Duration rallies. What is a duration rally? It means the bond market might go up. The next sentence I'd like to highlight here is productivity data tells a nuanced story. A nuanced story. What does that mean? It means uncertainty, continued uncertainty. In other words, he doesn't know. The next sentence I'd like to highlight is, I continue to believe AI will help firms claw back margin pressure and offset tariff-related cost increases over the next several years, but diffusion takes time. Tailwinds and headwinds, continued uncertainty, a lot of technical jargon, magic market whisperers. The next sentence, constructive at the margin, supportive for U.S. capital formation without adding to Washington's fiscal impulse. What is Washington's fiscal impulse? Well, raising taxes, perhaps. Supportive of U.S. capital formation? Well, I hope so. Of course, U.S. capital formation is the strongest in the history of the world. It always has been, will likely always will be. Next, investment implications are straightforward. They are a bond-led easing in financial conditions is bullish for equities, although the slowing of the economy will keep a cap on any exuberance. Well, at least here he's not predicting continued volatility. He's predicting lower volatility. But there's nothing straightforward about any of this. And he's also hedging his bets, and that's very common. Lastly, my base case has the S&P 500 grinding higher into year end with 10-year yields testing below 4%. In the next two labor prints remain soft. In other words, he's cautiously optimistic. So what do we have here? Cautiously optimistic, growth trend intact, headwinds and tailwinds, policy errors, and uncertainty. That is the professor emeritus at the Wharton School at the University of Pennsylvania, economics. Let's turn the page to forward or to market predictions. Essentially, those come in three varieties. There are forward-looking projections, which are the estimates of the Wall Street investment banking firms and trust departments about what U.S. stocks are likely to grow at for the next 12 months or 5 years, whatever the case may be. International stocks, high-quality bonds, they're predicting the future. Those are forward-looking assumptions. And then there are conservative assumptions. And these are projected rates of return that are lower than the historical averages. Forward-looking assumptions are always lower than the historical averages. They are always conservative, and they never materialize. Why? Because markets fluctuate. It is the range of expected returns that is important, because the median return is rare. Another way for market predictions to be made by Wall Street firms and investment banks is to take the historical data and then reduce the time frame to something more recent, maybe the last 20 years, maybe the last 25 years, maybe the last 30 years. The thinking is that market conditions have changed, everything is different this time, and what happened 50, 60, 70 years ago is irrelevant, and besides, the numbers are more conservative. So what does all this mean to you as an investor? Most investors as well as most advisors, fall into the category of what I call in my book the pragmatic rate of return investor. And here I'm quoting from the Moneyball Method. With all the pragmatism and all of the complexity that we're faced with, the pragmatic return investor believes that capital markets and monetary policy are complex. Your priorities are weighted toward financial planning, customized strategies, and superior risk-adjusted returns. To help increase your net worth, you stay informed about economic forecasts for a broadly diversified investment strategy, market predictions for sector bets on which industry groups might underperform or outperform, and technical charts or behavioral finance for market timing. That is what we are trying to get away from with the Moneyball Method, that kind of pragmatic thinking and surrendering to the complexity of the economic analysts and market forecasters is what we want to replace. And I'll get into that in a little bit later in this conversation. But regarding the implementation of that strategy, the pragmatic beat the market risk-adjusted return strategy, is to fill all of the style boxes, all of the various categories for maximum diversification, as mentioned in the introduction to this conversation. Essentially, there are 9 different style boxes that you can fill within the category of American US stocks. There's large cap, small cap, mid cap, value, growth, and blend. If you filled all of them, you would have 9. The same is true for international. You have style boxes of international developed economies as well as emerging markets. And then within the categories of fixed income or bonds, you've got high yield bonds, high grade bonds, short-term bonds, long-term bonds, international bonds, emerging market debt, and variable rate debt. I think what I've discovered in my experience working with investors is that many of them have 12 or 14 different styles, different mutual funds, different exchange traded funds. All of that is for maximum diversification. And some of those are actively managed. Some of them are passively managed index funds. Some of them are what are called factor-based or smart beta. So if you want to diversify across size, style, equity, fixed income, domestic, international, you could have an awful lot of complexity built into just one account. And what does that mean? When you combine economic forecasts, market predictions, 14 different style boxes, all for maximum diversification, trying to beat the market and do that on a risk-adjusted basis, how many potential assumption errors have you taken on? Every economic forecast is loaded with potential assumption errors. Every set of capital market assumptions that are forward-looking or conservative are loaded with potential assumption errors. I personally subscribe to the efficient market hypothesis and modern portfolio theory. And even within modern portfolio theory, there are 3 defining attributes for every asset class. One is the median expected return. Another is the standard deviation or volatility of that particular asset class. And the third is how they correlate with each other. Now, there's no guarantee that all of those attributes are going to perform as they have in the past. All 3 of those are potential assumption errors. Every time you add an asset class to your portfolio, you are adding 3 potential assumption errors. When you go from 4 to 14 different asset classes, you've added 10 times 3, which is 30 potential assumption errors. Now, all of those will balance out, and as you add more, each one will diminish in their impact, certainly. But then you combine that with the assumption errors from the economic forecast, the sector overweights and underweights, And you've got a lot of potential assumption errors that we can control, that we don't have to assume, that we can manage and minimize. And that is what the Moneyball method will do for you, is to minimize those potential assumption errors. And with that, I would like to read to you an ad that I saw on TV just this week. It talks about diversification. It talks about adding another style box to your investment strategy portfolio. This is from a major mutual fund complex. And what they say is the number of public companies is shrinking. The number of private companies is increasing. Yes, that's been going on for decades. This is America. The number of private companies is almost always increasing, at least when we do not have a recession. Small privately held companies are the lifeblood of any capitalist system, and certainly any complex division of labor economy will have a growing number of private companies. The number of public companies is shrinking. Well, that's been going on for a long time as well. A lot of companies have probably realized that being publicly traded and all the regulatory requirements that go along with that just isn't worth it. And they don't necessarily need it for access to the capital markets. They can have access to the capital markets through private equity, through venture capital, through merchant banking. And so the number of public companies actually is decreasing. That is not necessarily a reason to move money out of publicly traded securities into private equity, private debt, or private real estate. The ad goes on to say is that expanding access to the growing opportunity of private real estate, private equity, and private credit would increase your diversification. Is that true? What is diversification? What is the benefit of diversification? The benefit of diversification, according to modern portfolio theory, as discovered by Harry Markowitz and published in his Nobel Prize-winning paper, is to maximize your rate of return at any given level of risk over the long run. In other words, a positive risk and reward relationship. That means a properly diversified portfolio. Not everything is going up at the same time, because we certainly don't want everything to be going down at the same time. We want assets that are not going to be positively and perfectly correlated with each other all the time. If we do, then in the event of a large deviation event, a drop in equity prices, both in America and internationally, at least we have something that is helping preserve your net worth, that is helping preserve your spending capacity. And I would argue that the value of your private equity and private real estate holdings will go down sharply as the US stock market and international markets go down, if and when they do. I don't know that there's much, if any, diversification benefit to that. 2008 was a perfect example. There was nowhere to hide except for one category, the one category that has the greatest track record for being resilient in the face of an equity decline, and that is US Treasury bonds. So I'm not sure that there's any advantage to private equity, and from a diversification standpoint. The other is higher returns. Clearly, you expect to be rewarded for the liquidity risk of taking on private investments that are not tradable. But in order to achieve that higher return, you need to hold on to that investment until it comes to completion, until it matures, so to speak, until there's a liquidity event when your capital will return to you with any unearned dividends and capital gains. However, what if you needed to sell it before it goes full cycle? You need to find a buyer. There are buyers. You can sell it. There is a secondary market for those. It is not very liquid, and the buyers are not stupid. They are going to buy your interest in your private equity and your private real estate and your private debt at a sharply discounted price to what you paid. That's how they make money. That's okay. But for you, as the owner of that interest that needs to sell it, you're going to take a haircut. Think of it like buying a new car. What's the value a week after it leaves the lot and you are the proud owner? A lot less than what you paid for it. The last thing I would like to discuss regarding complexity is the many different kinds of risks that are discussed in economic forecasts and market analysis. Some of those are valuation risk. We discussed that in last week's podcast. Right now, U.S. equity markets seem to be overvalued relative to their historical averages. And if valuations were to drop, then prices would drop. There's competitive risk. What if a new business, a new entrepreneur, a new company enters the marketplace in which the companies you own are competing? That might reduce the market share of the companies you own, and there's risks associated with that. There's also financial risk. What is the financial strength of the companies that you might own in your mutual fund or separately managed account or ETF? Are they heavily leveraged, meaning a lot of debt on the balance sheet? Financial risk is a third aspect. Another one is currency risk. How much of their revenue comes from overseas? Or if it's an international company, what is their revenue stream when converted into US dollars? And a fifth one is credit risk. What is the credit worthiness of the companies that you own in your mutual fund or ETF? And is that credit worthiness increasing or decreasing? If the credit quality is decreasing, that means their cost of borrowing funds will go up. There's commodity risk. What are the costs of goods sold? What are the inputs that goes into their basic products? If commodity prices are rising, will that have an effect on the bottom line? If so, what effect would that have on the price of the stocks that you own in your mutual fund or ETFs? Another one is political risk. What impact would elections have, or new regulatory restrictions that your companies might have? There's headline risk. What if an officer of a corporation gets into legal trouble? What impact will that have on the price of the stock? There's compliance risk. The government is constantly adding new regulations that you're in a heavily regulated industry, in particular, healthcare, finance come to mind, energy. What are the risks associated to that, and what impact did that have on the value of your mutual fund or ETF? And there's counterparty risk. Every company has hundreds or thousands of contractual relationships with labor, with suppliers, with customers. And what is the ability of those counterparties to meet their obligations? Right there, I've identified 10 risks that all of the analysts are obsessed with, except us. At the Moneyball Method, we don't pay attention to any of those risks because all of them are built into the price of the stocks that we own. To waste time and energy on that is just to add to the complexity. We're trying to eliminate the complexity that is the result of the pragmatism that is embedded in the economic forecasting industry. But where does this come from? What is the social and philosophical source of all of the pragmatism and complexity? I'd like to quote here political science professor Alan Bloom. He wrote in his book, "Equality and the welfare state were now part of the order of things, and what remained was to complete the democratic project. Psychotherapy would make individuals happy, as sociology would improve societies. This is what the precarious, not to say imaginary, distinction between fact and values meant." So what does all the pragmatism and the complexity do at a philosophical, sociological level? It separates fact from value. It separates cause from effect. It separates definitions from words and concepts. You may recall from the podcast last week that the Moneyball Method uses a tool called the fact and value matrix. We do that for a reason. Fact and value are two sides of the same coin. Facts are values, values are facts. And instead of focusing on the 10 risks that are already built into the price of securities that add to the complexity that we don't need or want, what do we think about? What are we concerned with? What can we control? I want to talk about 4 risks that we can control that respect the relationship between fact and value that will help you achieve long-term investing success. And the first one I've already mentioned, market risk. All of the 10 risks that I mentioned a few minutes ago are built into the price of the securities. They comprise market risk. We cannot control the market. We cannot predict what it's going to do, but we can do something important. We can control our exposure to market risk. That kind of flexibility is what makes the Moneyball method unique and morally defensible. The second risk we can control, the one that has the greatest impact on your success or failure, is overspending risk. We are going to calculate your spending capacity based on the value of your financial resources, other sources of income, age and life expectancy, saving and investing habits, and all of the goals that you would like to fund pay for the goals and aspirations that make your life worth living. If you spend more than what we are anticipating in order to keep your plans fully funded, there's a risk associated with that. You will eventually become underfunded. We can manage that. The third risk that we can control, one that is never discussed, and that is underperformance risk. It is very easy to avoid underperforming the indexes, the major market broad categories that we want to own, whether it's US stocks, international stocks, high quality bonds, money market funds, or commodities. We can model all of those, and we can avoid underperforming all of them simply by not trying to beat the market. Beating the market does not necessarily add to your investment success. Avoiding underperformance risk will. And the fourth one that I want to discuss is one that we can't predict or control, but is the basis for the modeling that I mentioned earlier, and that is sequence of return risk. Also mentioned in the previous podcast, the order of sequence of returns has a greater impact on your success or failure than your investment strategy. And what we do is we will integrate all 4 of these risks: market risk, overspending risk, underperformance risk, sequence of return risk, into a strategy that will help you answer the question, I know what I'm doing and why. In that spirit, I'd like to quote the last paragraph from my book, The Moneyball Method. It is not primarily about investing, but about redefining success. It is not primarily about investing success, but about principled action. It is not primarily about achieving those goals, but about the emotional payoff from your newly perfected Declaration of Independence. And that sounds like the preamble to the Declaration of Independence: life, liberty, and the pursuit of happiness. That is the Moneyball Method. Thank you for joining me today, and I hope to see you next week. Thank you.